One ETF for the entire portfolio. Easy portfolio making, they said. So in this video, we're going to talk about the Vanguard LifeStrategy ETFs, which are ETFs that have been available actually in the US for several years, but in Europe, they're actually very new. In this video, we're going to talk about the 80, the 60, the 40, and the 20 ETFs, which are all the ETFs that there are of this type, and we're going to see the advantages, the disadvantages, but also how to use these ETFs and for which type of investors they are best suited. So stay tuned. Hey, it's Dario and this is Divity Finance, a platform where we can share our best tips and tools when it comes to trading, investing, or finance in general. And if you love the subject, please consider subscribing. So these ETFs are called multi-asset ETFs. In this case, these particular ETFs have other ETFs inside. A multi-asset ETF or a multi-asset fund is simply a fund that has multiple assets in it. In this example, we have equity and we have bonds. And again, as I said, these equity and bonds are made with other ETFs. So we have a main container, and inside of it, we have other ETFs. Of course, the ETFs that are inside are from the same company, from the same financial institution, which is again Vanguard. So what does 80, 60, 40, 20 mean? Let's take the 80 for example. 80 simply means that there is an 80% equity inside the ETF and 20% bonds. And this percentage is kept like this for the entire duration, so forever, and meaning these are called Countertrend ETF or Countertrend funds. What is a Countertrend fund? Simply means that if one asset grows, it's going to be brought back by selling it and buying the other thing that's in the fund. For example, if in this year we have 80 equity and 20 bonds, and the next year the equity grows a lot and we will have 90% equity and 10% bonds, we are going to have to rebalance it by selling a little bit of stocks, so selling a little bit of the equity and buying a little bit of the bonds to then rebalance the things and go back to 80-20. So then an example of a trend following ETF, or a trend following index I should say, is for example the S&P 500, where when a company grows a lot, it's not going to be brought back, but it's going to represent a bigger portion of the entire index. Usually what we want in an investment fund is the first option, so a counter-trend thing, because when we have our strategy, we put it on the table, we write it down, and we say that for our investment we want an allocation of 80% equity and 20% bonds. We don't want that to change ever, or at least we don't want the market to change those percentages. These ETFs in particular are called actively managed ETF simply because of this thing, simply because they have to rebalance. But keep in mind that this is very different from true actively managed funds, because for actively managed funds we have someone that makes decisions on his own, on her own assumptions. But for these ETFs, we don't have any assumption, we just have that you have to keep 80% equity and 20% bonds. That's it. That's a mathematical thing, a precise rule that you have to follow. Therefore, yes, it is actively managed, but it's not true active management. So does it change for the other ETFs? Does it change for the 60, the 40 and 20? Absolutely not. It's the same thing for all these ETFs. So just the percentages will change. So as you may imagine, for the 60 ETF, you will have 60% equity, 40% bonds. For the 40 ETF, you will have 40% equity and 60% bonds. And for the 20, you will have 80% bonds and 20% equity. But it's not only that there is 4 ETFs, there is actually 8, because all these ETFs are both at accumulating and distributing, meaning you can accumulate the dividends, so it's an automated reinvestment, or distribute the dividends, so you will have the money in your own bank account. What do I prefer? As I said several times, I do prefer accumulating, simply because there is no reason why you should have dividends that you have to pay taxes on and that don't even generate new capital. So it doesn't simply make sense for me. You should keep in mind that these ETFs are very young. They have been launched at December 2020 and it's not a lot. As you may know, I like to see ETFs being 1 to, if possible, 3 years old. It's very important this for me because you have to see how the ETF behaves in several different situations of the market, when the market goes down, when the market goes up, to see if the ETF risks the listing or bankruptcy. Of course, keep in mind your money is gonna be there's no problem, but it's always a pain in the ass, if I can say that, to have an ETF delisted or bankrupt, because you will have your money maybe frozen, you don't know exactly what you have to do, and yeah, it's simply just a waste of time in general. Also, another thing, these ETFs, because they're very new, they are also very small. We have $40 million inside the ETF, actually 40 million euros, sorry. And yes, they grew a lot because they were at 1 million when they were launched, but now they are already 40 and it's not even past 1 year, which is promising, but still very small. I would like to see at least 100 million euros inside. That would be the best. But we're going to talk about these particular things in a little bit when we will talk about the advantages and disadvantages of these ETFs. They are all physical replication, and also the ETFs inside are physical replication, which is very good. As you may know, synthetic replication is good, there is no problem, but if you can avoid it, it's always better to avoid it, and if you have physical replication, is always better. I already explained what physical replication and synthetic replication means, but quickly, physical replication means that the ETF is going to buy the assets directly on the exchange. Synthetic replication means that the ETF is going to buy an instrument from a bank or from a financial institution, which gives the same returns of the index that they have to follow, the index that they have to replicate. So there is this difference, and there is like the risk of this financial institution that gives the returns to fail for synthetic replication, which is not there for the physical replication. Therefore, it's always better to have physical replication. If you want to buy these ETFs, you can find them on Borsa Italiana, which is the Italian stock exchange, and you can find them on the Xetra, which is the German stock exchange. Therefore, they are pretty available for every European person out there. It's good to mention another thing, which is that these are global ETFs, which is very good. They invest in the entire world, which is again good for diversification. It's always better to have this bigger diversification rather than a specific country, because specific countries have specific risk, and we already talked about specific risk in previous videos. If you want me to talk about specific risk some more, just leave a comment down below and we will talk about it. But specific risk is simply what we want to avoid with diversification. So we have two types of risks. One is the general investment risk, the other one is the specific risk. We like the general investment risk because that's what brings profits, but we don't want specific risk because that's what brings danger. As far as currency hedging goes, as you may know, I don't like currency hedging, but in this case we have currency hedging for the bonds portion of the ETF, and we don't have currency hedging for the stock portion of the ETF, which is normal. I mean, for bonds it's kind of good to have hedging, currency hedging, but for stocks is, for me, for what I think, useless. So in this ETF, for example, we have both. A little bit of currency hedging for the bonds and no currency hedging for the equity. And lastly, let's talk about the costs. We have 0.25% of costs, which is not very high, but again, we will talk about it when we talk about the disadvantages, because there is one note to make on this cost. So let's start right away with the advantages. First and foremost, we have two markets where we can invest with one single click. And these two markets are actually the two main pillars of every investment portfolio. As you may know, investment portfolios have three pillars: gold, stocks, and bonds. Actually, you could add a little bit of Bitcoin, but let's leave that for a next video. So yes, the three main pillars: stocks, bonds, and gold. In this case, we have the two main pillars: stocks and bonds. So we are pretty much done with the portfolio. We would just have to buy a little bit of gold, but it's not even necessary actually for certain capitals. So yes, the two main pillars are these ones, and these are the ones included in these ETFs. So that's very good. Another advantage is certainly the automated reallocation. When you have an investment portfolio, as I said before, you will have a certain percentages for all your assets, and you want to keep that percentage the same for several years or at least months, and especially you don't want these percentages to change because of the market. You want to think about the changes without looking at the market and then make those changes, but you don't want the market to change it itself. Therefore, you will have to manually rebalance the asset allocation. In this case, the ETFs do it for you. There is no need for manual reallocation of the assets. This simply means that the costs will be lower because you don't have to sell anything, and therefore you don't have to pay capital gains on anything, and also you don't have to pay commissions to the broker for selling and buying, which is always good. Of course, for certain countries this doesn't apply fully, for example Switzerland, where we don't pay capital gains on long-term investments. But now let's start with the disadvantages, because yes, there are disadvantages. One of the disadvantages is the small size of these ETFs. They are still very small, which means problem with liquidity. And what is problem with liquidity? There is problem with spreads. In this case, for Borsa Italiana, we have a maximum spread of 1.5%, and for the Xetra, we have a maximum spread of 3%. Now imagine, especially for the 80% bonds ETF, so the LifeStrategy 20, what impact a 1.5% or even a 3%, even worse, could have on a return for 1 year, for the first year. Because when you buy, if you have a spread of 1.5%, you're done. Boom, 1.5% lost already when you bought, and there is no coming back from there. And in this case, where the bond market is not doing that great at all, where the interest rates are at zero basically, you are gonna have a hard time having a positive return on the first year. So this is also something to keep in mind. Now let's go back to the costs, because well, 0.25% is not a lot, but what about the LifeStrategy 20 again? We have the bond market there. It's basically an ETF which is a bond ETF, and you give me a 0.25% cost on a bond ETF is a little bit high. Again, let's keep in mind that we are on a 0% interest rate these years, these times, so a 0.25% of cost, of annual expense for this ETF is a little bit high. So also that's something to keep in mind, but generally, well, no, the costs are pretty good, especially for the 80, LifeStrategy 80, LifeStrategy 60, and even LifeStrategy 40. So now let's go to the good part, how to use these ETFs and for which type of investors they are best suited. So let's start by making an example. I'm Dario, I have 25 to 30 years time horizon, and I have a high risk profile. Do I need one of these ETFs? No, absolutely not. I could go with 100% equity, which is actually what I did. So there is no need for these ETFs. I have a high risk profile, I have a long-term horizon, I can go with 100% equity. Now, let's say I'm still Dario, I have 10-15 years time horizon, and I have a medium risk profile. Do I want one of these ETFs? For sure, I could use the 80 LifeStrategy, for example, which is 80% equity and a little bit of bonds acting as cushion, which is very good. But let's think about this a little bit more. When we build an investment portfolio, we want to think about the goals first, not the product itself, not the financial instrument that we want to use, but the goal. As the goal goes closer, as we get closer to our goal, the time horizon will shrink, meaning we are going to need a different asset allocation. If we can start for a 15 years time horizon with 80% equity, we cannot have a 80% equity when we are 5 years from the goal. Therefore, we will have to change after some years our asset allocation, in this case our ETFs. So we will have to sell the entire ETF and then rebuy another ETF, for example the 60. So if we start with the 80, we will sell everything, then buy the 60, then sell everything, then buy the 30, and then sell everything and buy the 20, which is not very good for taxation and for commissions. Again, for Swiss people it's not a great problem, but for Italians and I believe also Germans and probably even French people and in the UK, you guys probably pay capital gains, I think. In Italy, I'm sure you do. In Italy, it's a 26%. Now imagine a 26% when you have to sell the entire portfolio. And you don't even sell the entire portfolio because you want those gains, but simply because you have to reallocate. So that's something to keep in mind. The alternative would be to have your own investment portfolio with 80% equity and 20% bonds, and then you will just have to sell a little bit of the equity and buy a little bit of the bonds to get to 60 and 40, which means less taxes on that, certainly less taxes on that, because you don't have to sell the entire thing. So yeah, at the end, these ETFs are good for beginners because you have one single solution, one simple solution, no reallocation, you just buy it and forget it. But for advanced people, for experts, and even for people that have big capitals, I'm thinking about €500,000 or 1 million euros, you may want to use other assets, other financial instruments to tune your investment portfolio, and these ETFs don't give you that, because these ETFs give you a simple solution and that's it, which means good for beginners. So yes, this is all I had to say for these ETFs. If you like the video, please leave it a like, and if you have any doubts, any questions, or any discussion you want to make, go down in the comments and please do write something. I will be there to read it. So yeah, this is all I had to say. I'm Dario. This was the video about the LifeStrategy Vanguard ETFs, and I will see you guys in the next video.